let's say in your accounts receivable you have $10,000. But because you've been in business for a while, or just like industry standards or whatever, you realize you're not going to get all $10,000. Whether it's people that just want to steal from you, whether they go out of business, whatever, you're not going to get it all. And so it's kind of the pessimistic view. You would put on there as, on your balance sheet, it would say less the allowance for doubtful accounts. And what that is basically you're bringing that back down to what is actually believable.
Okay.
And so in this class, they're just going to tell you pretty much what the allowance is. So let's say it's just like $200. So now your balance for your accounts receivable is technically still at $10,000, but the amount that gets added up with everything else will be the $9,800.
Okay.
Because we never want to overstate our assets. And so technically if you say you're going to get 100%, but you know you're not going to, you'd be overstating your assets.
Okay. That makes sense.
And so there's two different ways you can do that. Because there's the allowance method and then there's just the direct write-off. With the allowance method, you put the money into like the allowance, and then so you'd have, stay with it, bad debt expense. So for your journal entries, you'd have the bad debt expense, and then you'd have the allowance for the $200. And then later on, when you don't collect that account, or $200 worth, then you would debit the allowance and you would credit your accounts receivable. That way they no longer owe you, and you also take it out of your allowance.
Okay.
But the other way to do it, like let's say you just started or you do receive 100% generally, so the other way to do it, you would just do bad debt expense and then just accounts receivable. So in the end, it's the same account, or it's the same process, bad debt expense and accounts receivable, bad debt expense and accounts receivable. This one just has that middle step in there.
Okay. Which one's used most likely?
Not sure.
Not sure. But either of them works just the same?
Mm-hmm.
Okay.
Yeah, it's just like, this one you know you're not going to receive it all, and this one is more just, generally you do receive it all.
Okay.
It's just like a random occasion and you don't.
Okay. That makes sense.
Okay. And then, do you understand how to do interest?
Yeah, I know how to find it, like solve for it.
Okay.
And you just do interest revenue, right? And then interest income, or is it the other way? Debit interest income?
So it'd be interest receivable
Okay.
and interest revenue.
Okay, because interest revenue and interest income is the same.
Mm-hmm.
Okay.